we've seen the revenue cycle. We saw the management had placed the arcs on the revenue cycle. Then we as auditors, we came in. We first understood how the internal controls look. We understood the structure of those internal controls. We understood how management has placed the arcs. Then we moved on and we performed test of controls around those internal controls. We performed RIO around these arcs. Now let's do the same for the expenditure cycle. That's the cycle when goods come in, purchases of goods for the company. So you have the expenditure cycle, which is purchases of goods by the client. So it's purchases. When the client purchases goods, it generates accounts payable due to vendors, due to creditors. And then they pay out the cash. So it's cash payments. Now again, the word cash, high inherent risk. You don't want employees to be stealing away the cash. Cash means high amount of controls required. You want to make sure that the right amounts are being paid out to the vendors. There are no kickbacks happening in your company. You want the high level of ethics. Make sure cash is not getting misappropriated. Now, when we look at the expenditure cycle, let's talk about the same company, Reynolds. So they had 10,000 of the pens going out, being sold in the revenue cycle. On the expenditure cycle, let's say they need refills to manufacture these pens. So their production department says we need 10,000 refills to make 10,000 pens. So the production department sends into the stores a requisition that we need 10,000 refills. And let's say these stores generates a requisition. So it's a requisition and it's approved that yes, we would need 10,000 refills to make these 10,000 pens. Now this requisition is then sent to the purchase department. So this requisition goes to the purchase department, which sends out a purchase order. Remember, in the revenue cycle, this company received a purchase order from its customers. Now when they want goods from their vendors, they are sending out their purchase order. It's the other side of the game. So you had they receiving purchase orders in the revenue cycle. In the expenditure cycle, they are sending out purchase orders. So let's look at this. So you have purchase order by the purchase department. This purchase order goes out to the, so you have this requisition coming out of the purchase department and this purchase order going out to the vendor. Remember, revenue cycle, this purchase order was coming in to the company. Now expenditure cycle, the purchase department is sending out the purchase order. Now a copy of this purchase order also goes to the receiving department, which is going to receive in goods from the vendor. So you have the receiving department getting a copy of this purchase order. A copy of this purchase order also goes into the accounts payable department, because if you realize it's an accounts payable, right? When the vendor sends in goods, it's an accounts payable. So you also want a copy of that going to the accounts payable department. So purchase order made by the purchase department going into the vendor, because the vendor needs to know what the company needs. And then receiving department, because the receiving department is the one who's going to receive the goods from the vendor. The accounts payable department, they're going to receive the invoice from the vendor. Remember, in a revenue cycle, the billing department sent out the invoice and the shipping department sent out the goods. So the goods goes into the receiving department. The invoice goes into the accounts payable department. Now, a few tricks here. So let's say the vendor is sending out goods. The goods are going into the receiving department. So these are the goods. Now, the receiving department, when they receive the goods, they prepare a receiving report. Now think about it. The receiving department already knows what's supposed to be coming in from the vendor. So when they actually receive the goods, will they do all the hard work of checking what the vendor has sent? They would know the purchase order, right? they have a copy of the purchase order, they would think the vendor has sent the same quantity of goods as is mentioned in the purchase order. That is why what we do is the purchase order copy which goes into the receiving department is a blind copy. Sending a blind copy means the copy does not have the quantity mentioned on that. So when the vendor sends in the goods, the receiving department knows that they are supposed to be receiving refills from the vendor, but they do not know how many refills. They do not know it's 10,000 refills. It's a surprise for them. It's a blind copy coming in. That's why when the goods actually come in, the receiving department make all the effort to count the number of refills that they've got. So let's say every carton of refill has got 100 refills. So they would count 1 carton, 2 carton, 3 carton, 4. They would make sure that they have received 10,000 refills which were ordered to the vendor. So the purchase order copy which goes into the receiving department is a blind copy. Blind copy means the copy does not mention quantity. Now, when the receiving department receives the goods, it sends out the copy of this receiving report to the accounts payable department. So the accounts payable department knows that the receiving department here, they counted the number of refills and they found that they received 10,000 refills. Now, this vendor, they've sent the goods out. So the shipping department at the vendor, they've sent goods out to the company. Now, the billing department at the vendor, they're going to send out a copy of the invoice. That copy of invoice goes to accounts payable. So this is invoice. So guys, if you realize, it's basically the goods coming into the receiving department, the invoice going into the accounts payable department. So now let's look at the accounts payable department side. This accounts payable department, they have received a copy of the purchase order from the purchase department. Now, along with a copy of purchase order, they also receive a copy of the requisition. So from the purchase department, they not only get the purchase order, but they get the requisition plus PO. In other words, the accounts payable department has received all the documents in the cycle till now. They've received a copy of the requisition and PO here. They've received a copy of the receiving report. Yes. They've also received the invoice from the vendor. So now when they look at the documents, so they would compare the invoice of the vendor to the requisition and purchase order. Were the goods actually ordered? So were the goods ordered, the vendors that are sent in? Has the vendor sent in the right quantity of goods? So when they compare the invoice with the receiving report, they would check whether the right quantity of goods have been received by the company. So two questions here. Question number one, were the goods ordered? So they look at this versus the invoice. Second question, have the goods been received? So they compare the invoice with the receiving report. If both are yes, then they would say, now we will have to make a payment to the vendor. So that's what they say. So they'll now have to make a payment to the vendor because the vendor has sent down the goods, they have sent the invoice. Now the vendor needs a payment, a cash payment, a check payment to the vendor. So what they do is, accounts payable department, they generate a voucher. So they have a voucher being prepared here. Now a copy of this voucher along with all the documents is sent to the treasurer who would make the payments. So you have the treasurer who would be getting all the payments. So all this is sent to the treasurer. Now the treasurer writes out a check. And receives this voucher, also may do the remittance advice. Think about it. So the accounts payable department, they've received all the documents. They prepare a voucher that yes, we would have to make a payment to the vendor who supplied the goods which were ordered to him and which are received by the company. So when the accounts payable department sends the voucher into the treasurer, they send a copy of the requisition plus the purchase order here plus a copy of the invoice that they've received here plus a copy of the receiving report that they got here and naturally the voucher that they've prepared. So all these documents, they go into the treasurer. So treasurer receives all these documents, looks at it and says, okay, now we must make a payment to the vendor. So the treasurer writes out a check, signs it off and cancels the voucher. Look at it. The voucher was prepared by the accounts payable department that we need to make a payment. The treasurer, when he writes the check, he cancels that voucher and sends out the check along with the remittance advice back to the vendor. He does not send this check back to accounts payable. He couriers the check himself. So it goes out from the treasurer's department directly to the vendor. So here the vendor gets the check for the goods he sent. So here the vendor had sent the goods and the invoice. Now the vendor is receiving the check directly from the treasurer. So accounts payable basically confirmed to the treasurer that yes, they've got to make the payment to that vendor. Treasurer cancelled that voucher. Why did he cancel the voucher? So that on the same voucher, another payment is not issued. Because for one supply, for 10,000 refills, let's say at 50 cents each, $5,000, only $5,000 need to be issued to the vendor. They do not want to issue out 2 checks for the same bill that the vendor has raised. That is why he cancelled the voucher, so that the voucher never appears again. So he cancelled the voucher, sent in the check, maybe also sent in the remittance advice with the check. Remember in the mail room, they got the checks as well as the remittance advice. They segregated the checks and remittance advice once they received it. So when the vendor receives the check and the remittance advice, the mail room at the vendor, the receptionist at the vendor, they're going to separate the checks and remittance advice, prepare a pre-listing. Guys, you got to link this to the revenue cycle. Expenditure cycle is basically the other side of the revenue cycle. Now, if you look at it, goods were ordered, goods were received, the bills were recorded, the treasurer made the payment. Now, you also have another department which we call the accounting department. So you will have an accounting department. So the accounting department would receive a copy of the voucher from the accounts payable. So accounts payable department updates the accounts payable master. Accounting department, they update the general ledger so that the numbers flow into these financials. So you have the accounts payable department sending this copy of this voucher to the accounting department. The accounting department also gets a copy of the voucher and remittance advice, the cancelled voucher and remittance advice from the treasurer. So guys, let's look at arcs in this cycle. Remember, management is responsible for internal controls. Management is responsible for having the arcs in place. We are only looking at whether are the arcs in place, and then we would test the controls as auditors. Now, management puts the arcs in place. Why do they use this structure? So think about it. What is stores doing in arcs? They are doing the authorization. It could be stores, it could be a production department. So they do the authorization. It comes into the purchase department. What is purchase department doing? It's ordering the goods. It's basically authorizing the order of goods. So it's authorizing the order of goods, because now the company needs refills to make these pens. Sends them to the vendor as well as to the receiving department and the accounts payable department. Now the receiving department, what do they have? They have the refills, they have the custody of the goods. So they have custody and they receive goods. Receiving, right? They receive the goods. Naturally, when the receiving department receives the refills, they would send it back to stores or they would send it back to production teams so that they can produce the pens that were ordered. So purchase department is authorization, receiving department is having custody of the goods. Accounts payable department, they are doing the record keeping function. They are recording the bills that yes, we have an accounts payable and we need to pay out cash to them. So they are recording. Accounting department, they're also doing the recording function. They are updating the general ledger so that the numbers flow into the financials. Treasurer, he has got custody of the cash. He has got custody and he pays the vendors. He pays the bills to the vendors. So he pays vendors. It's very important. You have to realize that the treasurer needs to send the check directly out to the vendor. Think about it. If the treasurer is sending the check back to accounts payable, then this accounts payable guys, they are doing record keeping plus they have custody. That's the breakdown of the arcs. They can steal in the money. They can authorize false vouchers, send it to the treasurer, and the treasurer writes a check, send it back to them, pocket the cash. So the treasurer needs to send the check directly to the vendor, cannot send the check back to accounts payable. He also needs to make sure that he cancels the voucher. If he does not cancel the voucher, a same voucher can be presented again for payment to him, and they might end up bluffing the treasurer, pocketing the money. So you got to make sure that the treasurer does the right job. Now, if you remember, we also had treasurer in the revenue cycle. So whenever there was a bad debt happening, then we had the same treasurer come in and authorize bad debts. So you want a separate guy. So this treasurer is a guy with a lot of authority, pretty senior guy. He's got the authority for signing the checks. So he's got custody of all the cash that the company has. Here he's paying the vendors. In the revenue cycle, the same treasurer could be responsible for authorizing bad debts, because we didn't have any other person there in the revenue cycle to authorize bad debts, which is very important. We couldn't let the cashier authorize bad debts because cashier had custody. That is why the treasurer took the role of authorization there in the revenue cycle. Here in the expenditure cycle, he's got custody of all the cash. He makes payments to the vendors. So guys, this is exactly how it looks, a lovely expenditure cycle. I know you're loving my drawings here on the board, and you will remember this for your exams. Let's get to the book. We'll be talking about the expenditure cycle. So you've purchases, accounts payable, and cash disbursements. So it starts with stores or the requisitioning department, which authorizes the requisition, approved requisition. Write an A there. This requisition goes to the purchase department, which then authorizes the vendor to send in goods, or the issue purchase order to the vendor. So write A for the purchase department, authorization. A copy of this purchase order is sent to the receiving department, who would receive the goods from the vendor and then send it to stores. So the receiving department, they've got custody of the goods. Now, when the receiving department receive the goods, they send a copy of the receiving report to the accounts payable department, who's responsible for R, or record keeping. Now, the accounts payable department have also received a copy of the purchase order from the purchase department. So they put all the documents together, create a voucher, and send it to the treasurer, who's got custody of the cash, who's responsible for paying the vendors. Write C for treasurer. A copy of the voucher also goes to the accounting department, which is responsible for record keeping. The accounting department also receives a copy of the check and remittance advice from the treasurer. So guys, this is how the arc works in the expenditure cycle, and we've seen how duties are segregated, the S of our arcs. On page 32, let's look at a few documents and records frequently used in the expenditure cycle. Second one there, highlight purchase order or PO. So that's highlight a pre-numbered document issued to the vendor to request delivery of goods. Now we know that besides sending it to the vendor, highlight additional copies of the PO are sent to the requisitioning department. Highlight receiving department. For receiving department, write blind copy, no quantity. And then highlight the accounts payable department, who are going to be preparing the payment voucher. Now, the accounts payable department would prepare the payment voucher after, right, a three-way match, where the payables clerk would match, highlight the vendor invoice, which is received from the vendor, and highlight the purchase order, which is received from the purchase department, and highlight receiving report, which is received from the receiving department. And a couple of pointers about checks for vendor payment which are signed by the treasurer. Highlight before signing, the treasurer matches the amount on the check with the payment voucher and supporting documents. Highlight after signing, the treasurer cancels the payment voucher package basically stamps it as paid to ensure that the same voucher is not presented again for payment. On page 33, we've got sample arcs in the expenditure cycle. Highlight purchases. So management needs to highlight segregate authorization of purchases, recording of purchases, and custody of inventory. For highlight cash disbursements, management needs to highlight segregate recording of cash disbursements, custody of cash, that's for the treasurer, and highlight comparisons. Highlight individuals who prepare payment vouchers, that's the accounts payable department. They should not have any access to any unused POs. We're going to be spending a lot of time in Audit 4 talking about management assertions of cover-up. But let's quickly preview a couple of assertions that we've been talking again and again in Audit 3. Highlight completeness, and the auditor does tracing to test for completeness. Now, when we say completeness, management is asserting that highlight all purchases that should have been recorded, highlight have been recorded. Highlight existence or occurrence, and the auditor vouches to test for existence or occurrence. Here, the management asserts that highlight all purchases that have been recorded have actually occurred. We've looked at this dashboard again and again. Let's look at it once more for our expenditure cycle. So we know management responsible for internal control, they put the arcs in place. So the management here, they've put the arcs in place for the expenditure cycle. They have stores doing authorization. They have purchase department who is doing authorization for the goods. They're ordering the goods to the vendor. Then they have the receiving department who've got custody of the goods. They've got a treasurer who's got custody of the cash, who pays out checks. Look at it. Receiving department, they've got custody of the goods. Treasurer, he's got custody of the cash. Then they have an accounts payable department and an accounting department to do the record keeping function. So they have the segregation of the arcs out here. Then we as auditors, we step in. First, we do our risk assessment procedures wherein we understand the internal controls. We understand how this internal controls look. Does the management have arcs in place? And then we document whatever we find. So if you look at it here, let's say we've documented it as a flow chart. We've documented whatever we've found there at the clients. Now it's time for us to do our test of controls. As you know, we do RIO around these arcs. We'll do a RIO around these arcs placed by the management. Let's get there. So as an auditor, we do RIO around the arcs. So R of a RIO, that's re-performance. Let's say we go to the accounts payable department and we re-perform their creation of the voucher. So the accounts payable department, they get the requisition and purchase order from the purchase department. They get a copy of the receiving report from the receiving department. They get a copy of the invoice from the vendor, and then they look at everything, create the voucher so that the treasurer can make the payment. The treasurer knows the dollar amount to be sent to the vendor. Now, let's say we go to the accounts payable department and we prepare a voucher. We re-perform and then we compare. Are our results consistent with what the accounts payable department has done? If yes, maybe we can rely on the internal controls. So internal controls are good, they are reliable. The I of a RIO, it's inquiries. Let's say we walk into the treasurer's office, really highly paid, rich treasurers. So you walk into his office and want to check what exactly does he do. We ask the treasurer, do you receive vouchers with all documents from the accounts payable department? Do you make sure that you cancel the vouchers once you write the check? Do you send the checks directly to the vendor, or do you send the checks back to accounts payable? If the treasurer sends it back to accounts payable, that's breakdown of arcs, because these guys, they are responsible for record keeping. In that case, they would also have custody. They can pocket the cash. they can raise dummy vouchers, false vouchers, and then when they get the check, few of the checks, they pocket it, they endorse it in their favor, pocket the cash. So the treasurer would need to send the check directly to the vendor if the internal controls are good. So that could be inquiries. The second I for Rio, that's inspection. A lot of documents here for us to inspect, right? We can inspect requisitions, we can inspect the purchase orders, we can inspect the receiving report, inspect the vendor invoices, inspect the vouchers, inspect cancelled vouchers, remittance advice. So a lot of documents here for us to inspect. And we know inspection could be examination of documents, it could also be vouching or tracing. So this is a V, and you know the way our T looks. And everybody in class knows that Varun's really excellent in training of CPAs. Vouching in reverse order for existence, tracing in order for completeness. Let's put all the documents that we have on this cycle. So we start with the requisition. Then you have the purchase order. Next, the receiving report. Then you have the vendor invoice coming in. So after the vendor invoice comes in, the accounts payable department, they create a voucher. So you could say it's a payment voucher. Then we'll have a cancelled voucher, and then the remittance advice from the treasurer. Everything here goes into the journal, ledger, trial balance, and then you have the financial statements coming out, the balance sheet, the income statement, the statement of cash flows. So all that coming out here. So it flows in from the requisition purchase order. Finally, numbers get into the financial statements. Now, when you're tracing, you're starting from a lower document, lower source document to higher. You could start, let's say, from receiving reports, and then you could go on vendor invoices. So when you're tracing, you want to make sure that has the company received all vendor invoices for all receiving reports. Then you could trace from receiving reports to the financial statements. You would want to see whether all the goods that the company has received, have they received invoices for that, vendor invoices, and has all that been recorded on the financial statements. So you're tracing in order for completeness. Now, when you're looking at the expenditure cycle, as a professionally skeptic auditor, what would you think? Would management try to overstate or understate purchases? I would think that they might try to understate purchases. Think about it. If purchases are understated, they could show higher income here. Higher income means higher bonuses, more wealth for shareholders. So if they try to cook up the books, if they try to be fraudulent by any chance, they would try to understate purchases, understate expenses. So in that case, tracing might be really helpful. So if I'm tracing from vendor invoices, let's say from receiving reports to vendor invoices to the financial statements, I can find out, let's say on the financials, they've got 10 million of purchases, but in reality, they got 12 million of purchases. So when I look at the $12 million of receiving reports and I try to trace it to the financial statements, I can find out the 2 million of purchases that they have not recorded here. So think about completeness. When management is asserting that everything here is complete, they are asserting that all purchases that have happened have been recorded in here. So when we go on from that all purchases, all the receiving reports, all the purchase orders, all the requisitions, when we go in from them to the financial statements, when we trace up, we can see whether everything that has actually been purchased has been recorded. Now, vouching, that was more effective for the revenue cycle, where management may have tried to overstate revenues. But we'll still do vouching even for the expenditure cycle, just to make sure. Let's say when we are vouching from the vendor invoice to the receiving report to purchase order. So when we are vouching from vendor invoice to receiving report, so we want to make sure all the bills that have come in from vendors, have the goods actually been received? Were the goods actually ordered? Think about it. So when I'm vouching from vendor invoice to receiving report, it's basically like we've received a bill from the vendor, we've received an invoice from the vendor. Have the goods on the invoice been actually received? Were the goods on the invoice actually been ordered? So that's vouching. So vouch in reverse order for existence, trace in order for completeness. You know the mnemonic. Now we have the O of Rio, that's observation. Now lot of things here for us to observe. Let's say we get to the receiving department, we auditors, we with our own eyes, we hide and we see whether these guys actually count the goods which come in from the vendors. Do they count it 1, 2, 3 and 4? So we want to see, we want to observe whether the purchase orders that they're getting, is it a blind copy? Because we want to make sure these guys, they work really hard. They're paid for that. They are paid to check the goods that they get in from the vendors. We might go to the accounts payable department and observe there. So we hide in there and we observe. We see how they create the vouchers. Do they look at all the documents? Do they look at the purchase order and compare it with the receiving report with the vendor invoice to make sure that the right quantity of goods have come in, the goods were actually ordered by the company. So we want to observe what the accounts payable department is doing. We might even go to the treasurer's office and observe, is he signing of checks? Is he cancelling the vouchers? Is he sending the checks directly to the vendors? We want to make sure he doesn't send it back. So that's observation. Now we'll do a mixture of Rio. We can choose what we want to perform. We can do a reperformance, inquiry, inspection or observation. Very effective tools for us to make sure that the right kind of controls are present. We want to make sure, are these controls reliable or we cannot rely on them? If we can rely on them, maybe we can reduce the nature, extent, timing of a substantive test. If we cannot rely on these controls, if let's say controls were pathetic, they do not have segregation of arcs, in that case we will say we'll do more substantive testing, we'll check all the dollars here and we'll do a lot of substantive procedures. So guys, here we are looking at test of controls, we are doing Rio around the arcs to make sure whether controls are effective or ineffective, whether controls can be relied upon or they are not reliable. If they are in this form where arcs is segregated, more or less generally we could say we can rely on these controls. On page 34, we're talking about test of controls related to purchases. And again, a lovely table where we have all the departments, all the documents. We've got sample controls to be placed by management. Right there, management equals arcs. And the last column is sample test of controls by the auditor. And right there, auditor equals Rio. Move to page 35. We've got test of controls related to cash payments. So where we got sample controls to be placed by management, right? Management equals arcs. And once again, where we have sample test of controls by the auditor, right there, auditor equals Rio. In our RUCPAs, when we said U, we said the auditor comes in, he understands internal controls and he documents whatever he finds, where F of find was flowchart. Now I have done flowcharts here, but these are not accurate flowcharts. I have not used all the right symbols here. So let's try to understand what are the exact symbols that an auditor would use on a flowchart, and we would then compare it to the revenue cycle and the expenditure cycle that we have here. So let's look at all the symbols that we have on flowcharts. So we'll just do it a little on flowcharts. And I'm doing this for you to refer to your simulation number 1 on your book. So we'll use all the symbols for simulation number 1 and we're going to compare it to that expenditure cycle that we have on the other side of the board. So you have this as a symbol for document. It's not exactly this. You could say, I've made it simpler. It could be like this. So you have something like this. So this is a document symbol. Then you have a symbol for data. Now I'm sure you understand document, right? Document would be, let's say, the purchase order there. It could be the receiving report there, voucher. So all those are documents. So that's a symbol for that. This is data. So this is basically journal or ledger. So when you have the accounts payable department updating the accounts payable master, the accounting department updating the general ledger. So this is the symbol for data. Then you would have this symbol, a trapezium, for manual operations. So let's say when the goods come into the receiving department, they count the goods. That's a manual operation. When the accounts payable department, they get all documents from the purchase department, from the vendor invoice and the receiving department. They match everything. That's a manual operation. We'll look at that when we see the simulation. Then you have this is a symbol for a computerized process. Computerized operation. So you have document, data, manual and computerized operations. Then you have this as a symbol for a decision box. There are a lot of times in life when you have to take a decision. So this is your decision box. If it's yes, you go a particular direction. If it's no, you go another direction. So that's decision box. Take a decision. Then you have certain connectors. Now think about it. Flowcharts can get real lengthy. If it's a big company with a very complex process, lot of controls in place, you might have a very huge flowchart. There might be times when you want to split that flowchart into a lot of pieces on the same page and connect them. That is when you use something we call an on-page connector. So if you have a circle, this is an on-page connector. If you have something like this, that's an off-page connector. So this is an on-page connector, which connects the various parts of the flowchart on the same page. Off-page connector, if you have flowchart extending into more than one page, then you might use an off-page connector. Okay, so we're done with document, data, operations, decisions, connectors. Let's look at storage. So you want to store data. So we have this. This is a symbol for tape storage. When you store data in tapes, this is disk storage. When you store data in disks, this is online storage. But the most important among storages, this is an inverted triangle, that's offline storage. That's basically creating a file. So whenever a department creates documents, so let's say the purchase department, they create purchase orders which is sent to vendors, which is sent to the receiving department, which is sent to the accounts payable department. Now they also want to keep a copy of that in their own file. So this is the symbol for that. This is offline storage. So it's offline storage. I would simply call it whenever they want to file it. So I would say it's filing. So these are basically the most important symbols that we use for flowcharts: document, data, operations, decision, connectors, and you have all these four. These are symbols for storage. Now let's get to the first simulation that we have on our book, and we'll look at comparing these symbols with the expenditure cycle. So you have simulation number 1 on your book, which says the following flowchart depicts part of a client's purchases and cash disbursement cycle. Purchases and cash disbursement cycle. Some of the flowchart symbols are labeled to indicate operations, controls and records. For each symbol numbered 1 through 12, select one response from the answer list below. Each response in the list may be selected once or not at all. So you have responses A through response T. Now you're going to match this with the 12 questions that you have, 12 boxes that you have. So basically 12 symbols which are unidentified on your flowchart there. So if you look at this flowchart, this has got one side. So the first column of the flowchart, as I would call it, is purchasing. So the first column deals with the purchase department. The second column deals with the receiving department. Third column deals with vouchers payable or accounts payable. The fourth column has a top box number 10. I think that would be the treasurer. But let's look at that. So let's look at the first column, the purchase department, purchasing. So it says from stores they get an approved requisition. So purchasing gets an approved requisition from stores. That's cool. Then they do manual operation. Okay, then you have a trapezium. The trapezium box, does it look like this? Manual operation. So what's the manual operation that the purchase department does before it can send out purchase orders everywhere? So the manual operation is prepare this purchase order. So let's match it to our answer responses. It matches with response C. So response C is prepare purchase order. So the purchasing department does a manual operation of preparing these purchase orders. Then if you look at the first copy of purchase order is sent out to connector 2. We look at that. The second copy of purchase order is sent out to stores. That's cool. So stores know that vendor has been given an order. The third copy of purchase order, it's an inverted triangle, says by number. That's basically filing. So it's filed. The fourth copy of purchase order, it's sent to receiving. Receiving, remember, it's a blind copy. The fifth copy of purchase order along with a copy of the requisition is sent to vouchers payable or accounts payable. Make sense? So you have number 2, that's a circle. What's a circle, guys? What's a circle? That's an on-page connector. So what is an on-page connector here? So think about it. They have mentioned purchase orders going to the stores, to receiving department, to accounts payable. What's missing? Number 2 could be vendor, because until unless you have a purchase order going to the vendor, how would the vendor know what to supply? So number 2 would match with response R, which is to vendor. So that was the first column where we talked about the purchase department. Now the next column, that's talking about the receiving department. So it says receiving department gets from purchases a copy of the purchase order. So they're getting from purchases a copy of the purchase order. That's cool. Then they do a manual operation wherein they receive the goods, match with purchase order. Yes, they receive the goods and they match the goods with a purchase order. Now the purchase order that they get only contains the type and description of the goods. That does not contain the quantity. It's a blind copy. So when they get the goods from the vendor, they count the goods and they want to check whether the type, the description of the goods matches with the purchase order that they've received from the purchasing department. So that's a manual operation. Then you have another manual operation box number 3, which is empty. So you got to identify what that is. So what does the receiving department do apart from comparing the goods with the purchase order before it can send out copies of the receiving reports? It prepares the receiving report. So number 3 manual operation would be your answer response F, which is prepare receiving report. Then if you look at that, the prepared receiving report, the first copy is sent to vouchers payable. That's cool. The second copy of receiving report along with the third copy is sent back to stores. So the stores know now that goods have been received by the company. The fourth copy of the receiving report along with the fourth copy of purchase order is by number. It's filed by number. Remember, it's an inverted triangle. Inverted triangle is offline storage, filing by number. Then you have going to stores and stuff. So that was basically the second column. So we are done with number 1, 2 and 3. Number 1 was option C, prepare purchase order. Number 2 was option R, to vendor. Number 3 was option F, prepare receiving report. Now let's look at the third column, which is vouchers payable or accounts payable. Now on the top of this column, you have a couple of circles there. So 3 circles there actually. So there are 3 on-page connectors. So you have 2 on-page connectors which are 4 and 5 and you have the third on-page connector from vendor. So now guys, let's try to analyze what does the accounts payable department get. It gets a copy of the purchase order plus a requisition from the purchase department. It gets a copy of the receiving report from the receiving department and it gets a copy of the invoice coming in from the vendor. So number 4, connector number 4 has documents requisition 1 and an empty document number 6. What's that? So number 4 looks like from purchasing. So they're getting from purchasing department. And number 6 is a purchase order. So guys, now I want you to get to the first column where we looked at the purchase department. Look at that. So on the purchase department, after they prepared the purchase order, the box number 1, the manual operation box number 1, you had the 5th purchase order and the first requisition going to vouchers payable. So when in column number 1 they sent out these two documents to vouchers payable. Now in the third column when we are looking at vouchers payable, they have received those documents. So you have connector number 4, that's from purchasing, and we can match it to response L, which is from purchasing, and the document box number 6, that would be purchase order, or actually purchase order number 5, and we can match it to option O for orange. Now, so accounts payable is getting the invoice from the vendor, and they're getting requisition plus purchase order from the purchasing department. They would also get the receiving report from the receiving department. So connector number 5, that would be from receiving, and you can match it to M for miles. Document number 7, that would be the receiving report, and you can match it to option P. So option P is receiving report number 1. So if you look at the second column for receiving, you can see that receiving is sending receiving report, the first copy to vouchers payable. So in second column, receiving department, they were sending out the document, and the third column, the accounts payable, they are receiving the document. So they're receiving a copy of the receiving report from the receiving department. Then if you see, everything is put together, and then they match documents. So accounts payable puts everything together, they match the documents, and then you have another empty manual operation box number 8. So after they match documents, what do they do? After they match documents, they prepare the voucher before they can send it out. So number 8 would match to answer option number B, which is prepare and approve voucher. Makes sense. So accounts payable department would first match the documents, and they would prepare the voucher. Then after they prepare the voucher, let's look at what they do next. They have approved voucher number 1, which they file. You have an offline storage file, and it says by 9. So that's number 9. We have to identify that. So that's approved voucher. What else? So along with approved voucher, they have an invoice, they have a receiving report, they have a purchase order, and they have a requisition. So they have this entire thing which they file it. Now number 9 would be best matched with option T, where the vouchers payable or accounts payable department creates an unpaid voucher file filed by due date. So 9 is T. Think about it. So you have goods coming to the company. Now let's say the vendor is giving the company a credit period of 30 days to pay the bills. Now accounts payable, they might prepare the voucher on the second day of the receipt of the goods. Now the payment needs to be made after another 29 days. They would file the voucher in an unpaid voucher file by due date, so that on the 30th day when the payment is due to the vendor, the treasurer can take it out from there, cancel the voucher, send out the check. So this voucher goes into an unpaid voucher file filed by due date, option T. Then you have to treasurer, it goes to the treasurer. After you create that file, the accounts payable department sends it to the treasurer, so that the treasurer can pay it on the due date. Then you have number 10. So number 10, that's the heading of the fourth column. So we've talked about purchase department, we've talked about receiving, we've looked at accounts payable. Now the fourth one, from vouchers payable, they're getting the entire package. Who gets this package from vouchers payable? Treasurer. So number 10 is treasurer, option S. So treasurer gets this entire package from accounts payable or vouchers payable. He then does a manual operation, which is review documents, prepare, check, and remittance advice. So he would review all the documents, he would prepare a check, prepare a remittance advice. What else would he do? He would cancel this voucher, right? So cancel this voucher looks best with option I. So the manual operation box number 11 would correspond best with your answer response I, which is signs, checks, and cancels voucher package. So step number 1, so manual operation number 1, the treasurer reviews the documents, he looks at all the documents, he prepares the check, prepares the remittance advice. Manual operation number 2, he signs the check, cancels the voucher, and then he would naturally courier it to the vendor, mail it to the vendor. Then you have After he signs the check and cancels voucher package, that's manual operation 11. You have a document for number 12, which is file by number cancelled voucher package file. So number 12, the document is matching best with your answer response K, cancelled voucher package. So once the vouchers is cancelled, the treasurer would file the cancelled vouchers on a cancelled voucher package file. And then if you look on the other side, you have the remittance advice and signed check going to the vendor. So you have this remittance advice and signed check going to the vendor, and you have a copy of this check and the remittance advice which is going to accounting. So guys, you're getting the flow here. We have done numbers 1 through 12. I'll just quickly check whether you've gotten the right answers on your book. So number 1 matched with response C, prepare purchase order. Number 2 matched with response R, to vendor. Number 3 again was a manual operation box which matched with response F, prepare receiving report. Number 4, which was an on-page connector, matched with response L, from purchasing. Number 5, again another on-page connector for vouchers payable. It matched best with option M, from receiving. Number 6, which was a document, matched best with option O, purchase order number 5. Number 7, another document, matched best with option P, receiving report number 1. Number 8, another manual operation, was option B, prepare and approve voucher. Number 9, which was basically an offline storage, remember, an inverted triangle. So if you look at number 9, it was an offline storage like this, matched best with option T, which was an unpaid voucher file, filed by due date. So unpaid voucher file created by the accounts payable department, which then went to the treasurer. Number 10, that was option S, treasurer. Number 11, which was option I, because it was a manual operation, which meant signs the checks and cancels voucher package. Number 12 matched with response K, because that was a document which was a cancelled voucher package. So guys, I know it's not very simple, it's a little complicated, but if you know the cycle really well, you can surely solve it. So you need to know two things. Number 1, you don't need to know this cycle. This is very important. And the second thing that you would really want to know are these flow charts. So you're aware of the symbols, not so highly tested on the CPA exam, not to worry about this, but it's still good to know. You're going to be CPAs, and remember, are you CPAs? So the U of are you CPAs was document whatever you find. So you need to know all these flow charts so that you can create this when you're there on an audit.